You've got to still remember the US is the global reserve currency. If there was a buyer's strike across the globe, everyone would be shooting their own reserves in the foot. That's the first thing to remember. This would be a global hegemonic change. We haven't seen one of those for many years, like the British Commonwealth and other hegemonies. You're looking at quite a long period of transition to get to that. So I don't think that's something that's naturally going to happen overnight. Of course, the deficits are a big concern, but there are still buyers out there. Look at some of the auctions, still seeing buyers. You've got US Treasury yields higher than Greek debt yields, for example. Only about, 10 years ago, we were looking at Greece potentially defaulting. So in the short term, I think there's going to be a lot of noise. I think this is a much longer term trend. We would need to see quite a significant change in global hegemony, and I'm not sure we're ready for that as a globe right now.
And I did a lot of work on this with the Barron's article, with the comments about TLT and the BlackRock products as well, and also looked at a Bloomberg piece as well. And I think it put it really well. There's 5 factors. 1, you've had the Federal Reserve tightening. 2, the Fed has kind of stopped buying because of the quantitizing, rising, easing. A lot of governments, and I know it would take a seismic shift to make it more meaningful, but foreign governments and US banks have curtailed their bond purchases. Pandemic infrastructure spending and tax revenue shortfalls have added more than $7 trillion to the national debt in the last 3 years, plus downgrading US debt from its top rating happened over at Fitch quite recently as well. A lot of reasons why, and that's a Bloomberg article, by the way, a lot of reasons why you might want to not rush in too headlong into the bond market.
Yeah, I mean, that's the argument for the long end right now. I mean, it's why the long end's been struggling. We've seen a bit of this disinversion. We've gone from 100 basis points of negative inversion to where we are about 17, 18 basis points of inversion. But historically, this is the other side of the fence. Historically, when curves disinvert above their 30-day moving average, every single time there's been a potential recession. Now, it's very dangerous to say this time is different. So, arguably, we've just seen, the S&P down 11%. Is that going to stop equity buyers coming back out at some point? Arguably not. I do think that the Treasury market will likely rally if we hit a recession. I can't imagine that we will see the Treasury market continue to sell off if we get a recession, because expectations will be for more rate cuts.